The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. Here are your headlines today. Weak Chinese consumption keeps a lid on consumer prices in the world's second largest economy, while factory gate prices decline for the 20th month in a straight run. The EU is reportedly set to more than double tariffs on Chinese EVs today, ramping up pressure on Beijing and risking retaliation.
Apple hitting record high after its best day since 2002 as analysts turn bullish on the Cupertino giant's big AI play. And green light or a road to nowhere. UK Prime Minister Rishi Sunak unveils his party's election manifesto at the iconic Silverstone racetrack in a bid to overtake in the polls one policy top of the agenda.
This election is right to talk about the future. The future that we want to deliver for our country is one where, above all, families will have financial security because their taxes are being cut.
It's a big old day today, isn't it? We're setting up for some really big numbers when it comes to CPI. The market's closely watching what the inflation print looks like. And I think when it comes to monetary policy, are we joining the dots or are we removing dots at this stage? The market's been looking for some fresh clues around what the pathway looks like on those rate reductions. But in fact, what they may get today from the Fed could be a removal of some of those for 2024, which would mark a little bit more disappointment, I think, from where we started out the year.
Yeah, so and I think this is one of the questions that I will ask as well across the days. What more can the Fed say now that they haven't said before? Because they'll literally be, and we can probably do a checklist on all of this, right? They'll probably say they need to still look at more data. They need to make sure that all that data is still aligned to bringing inflation down to 2%, to want to make sure that growth. But my question mark is, what did that 4% figure on unemployment last week, Friday, then do? Did that give them the sense that, okay, we are moving in the right direction? Or was the headline figure of 272,000 jobs added in the economy still the factor that holds them back, I think, substantially? I think all of those are still big question marks still for the Fed.
I think for those who are pushing back on the dovish side, they're still saying, look, we're getting some disinflation coming through. We are starting to see some progress when it comes to all these different data points. But the reality is it's not quick enough, is it? It's taking quite some time in terms of that lag effect. And I think the market is looking today at whether there is genuine progress made with this high level of restriction, or whether high for longer is going to cut it, or whether we're still in a process now where that final mile is not going to close, and whether the Fed starts to get impatient.
It's always the last mile that we spoke about. But on the other side, if we take a look at equities, I mean, it's all been about Apple actually over the last 2 days. I know we keep speaking about NVIDIA. Let's see how that actually impacted the markets quite substantially, because that's actually what you got from this market movement yesterday. It was the Apple effect, right? And some would wonder then that right after the announcement of those, that's how we call it, Apple Intelligence, then that Apple had put forward at its Cupertino headquarters, they had made note quite substantially of the things that they would change, the things they would bring in. The market took it a little bit coolly. That went down 2%. Yesterday, however, just after that had all come through, perhaps investors taking in a whole lot more of what Apple had said, now the shares managed to spike around 7%. We'll get into all of that. But overall, this is what you then got from this market. An uptick then, particularly on the NASDAQ side. Tech counters, again, still doing fairly well, including NVIDIA. Really, you could just say NVIDIA and Apple went up. So what happened to the rest of the market? Well, it went higher. That's pretty much the sense you get then from this market. Is there more legs, though? Are there more legs from this market movement? Elsewhere, of course, caution is still in the market, as we've just been speaking with Karen, that CPI print will be very important for the market a little bit later on today. A slim 0.1% uptick is the one expected from a month earlier. Here's your US tech then and Apple. The best day since 2022. I think of the headline, I said 2002, right? That would have been a retrofit on that one. But 2022, the best day for Apple since that mark, then going up 7.3% ultimately. 14 points gain, 207 is where you're seeing it. If you bought Apple at anywhere near this 207 mark, whether it be just before then this AI announcement put forward by Apple, you're anticipating significant growth because you want the numbers to grow. You want more sales to come out of this AI push. Did you get that? That's the question mark we'll be asking then across the day's trade. General positivity, you do see a downside from Tesla, which has really been the case for most parts of this year. Out of Asia then, this is what you're getting for this Asian market so far. Mixed as investors assess the inflation data from around the Asian region. Of course, we've had China inflation numbers also come out. We'll unpack those in just a moment or two. The data perhaps maintaining some pressure then, particularly on stimulus. Producer prices also falling a little bit less than anticipated. Still in negative territory though. Markets, of course, still looking towards the Fed. Negativity though is the sentiment you're getting. Even the Hang Seng Index down significant 1.3% so far this morning. Karen.
Arabile, we started out the show talking about data points, and we have some data already. Chinese inflation continued to diverge in May, with the consumer prices coming in 0.3% higher on the year, while factory gate prices fell almost 1.5% for the 20th consecutive month. Let's get out to Sam for more from Singapore. Sam, even though we've got an annual increase in CPI, the month-on-month rate actually declined.
Yes, I'm glad that you pointed that out, Karen, because that is something that is a concerning trend, because while we have seen on an annual basis that CPI staying steady, as you mentioned, sequentially falling 0.1%, we've got to remember this was capturing the May long weekend, that May Day, Labor Day holiday, where we did see an increase in spending and travel. So that very much speaks to perhaps the concerning trend within the demand story right now with regards to some of that inflation. You talked about the divergence. We were talking about this on Street Signs this morning, Asia time, Tanvir and I, about the splitflation and how that gap between the CPI and the PPI has actually narrowed. So there was no major sort of surprises in that data, really, because we did see the producer prices improving in terms of that deflation easing, and then we did see the CPI holding steady. Let me just dig into the wholesale prices very quickly, because what we have seen is a bottoming out. We have continued to see this deflationary pressure playing out for around 18 months, but we had about a 1.5% read on that in May. And so, and many analysts are putting that down to the sort of higher commodity prices, what we've seen, particularly around copper and gold. And so they say that that is largely down to that rather than a domestic demand story, because we know that there are still headwinds when it comes to the property sector. And so the big question now, as analysts have pointed out, is whether the PPI can actually jump back into that sort of positive territory in the second half of the year if those commodity prices do stay high. But certainly the data is continuing to tell us that it is a tale of two economies. It continues to look encouraging on the supply side, but not so much on the demand side. And so we still need to see more policy steps in order for that demand to absorb some of that capacity story that we've been talking about. So no doubt this data continues to tell us, guys, that the PBOC does have its work cut out for it, and the policy traction is still a bit of a problem over in China. Back to you.
Sam, thank you very much for setting the scene for us. Duncan Wrigley's joined us, Chief China Economist at Pantheon Macroeconomics. Duncan, what's going wrong with the consumer? We know that the housing market's been very difficult for a long time. The Chinese authorities have tried to throw some stimulus measures at the economy, but why is it not working seemingly at this stage?
Right, you're absolutely right to look at the Chinese economy in terms of property and the rest of the economy. If you look at the rest of the economy, the consumers are spending in some areas, whether it's tourism, healthcare. Cars are holding off for a bit because there's a ferocious price war, but that will probably come back with some incentive policies, trading policies coming in. On the property side, the property market's been in this big, deep structural downturn since the second half of 2021. There is a bunch of new policies where the government is trying to stabilise the property market, especially by promoting local governments buying up some of the excess inventories, both new and second-hand market. But the reality is that the property market is still in this deep bottoming out stage. It's going to take several years. We're seeing a few small green shoots here and there in some of the big cities, land sales in Shanghai, for example, or the luxury housing market. But these are very early green shoots. for the property market in China as a whole to start to pull round.
Let's just fit China into the global jigsaw and what its relevance is, because in the past we've seen the impact on inflation, we've seen the impact on growth. How do we think about those metrics? Because Sam mentioned there that PPI inflation could turn positive in the second half. In particular, she was looking at the commodity price drivers here, copper. How does China move in relevance to the rest of the world economy for the rest of this year?
Well, the way I see the PPI in China is there's two components. One are international commodity and energy prices, which in China the prices are very closely tied. I mean, these are international prices. So you're right, you are seeing a bit of a pickup, copper, also iron ore, oil prices, but those are very much international market prices. China has a role there in demand, but they're internationally set. But if you look at the China component domestically, there are still signs in many industries of low capacity utilization, ranging from solar, autos, many manufactured sectors where China has invested. China wants to become an even larger manufacturing power in the world. And one of the stimulus policies in China has been sending more money into manufacturing investment, boosting capacity further. So there's those two elements. The China element, which is to do with managing manufacturing supply and capacity, will remain quite large and therefore put downward pressure on prices still in the second half of the year and going forward. The international commodity and energy prices may start to stabilize.
Is stimulus the only way to get that economy back up? Is that all that's necessary at this stage?
Well, I would say that there's a limited amount that stimulus can do in China right now. Certainly within the framework that Chinese policymakers have set themselves, which is China has very high debt overall. And China doesn't want to go back down the old route of just, huge credit-propelled debt stimulus into the property sector it used to be, right? So given that constraint, what China is doing or trying to do is to restructure the economy towards other sectors which aren't so debt reliant, including manufacturing, but also services, consumption. And, especially services and consumption, that's much more market led. It depends a lot on consumer sentiment, households, and that just takes a little while to repair. I think there's a limited amount that the government can actually do in terms of stimulus. So basically China and the rest of the world needs to be patient.
Yeah. You still need to put in some stimulus though to revive the same property sector that you got to the stage because of the same stimulus in a sense, right? Because this is going to feed onto itself in many ways.
It has been feeding onto itself for the last few years. The very famous developer debt crisis, hit the housing sales and now hit supply. And I wouldn't be surprised if we do see PBOC making some token interest rate cuts perhaps this month. But I would still frame them as token because they don't address the underlying causes of the property sector downturn. And one of those deep causes right now is a huge excess of supply, both in the new market, the huge pipeline of properties under construction, the amount of new housing that's been approved for sale on the market, especially in lower tier city markets, but also the new phenomenon this time round is the excess of second-hand housing supply. And that's because many people who bought multiple units back in the day when they're very cheap for investment, seeing there was a lifetime store of value, now they're not so confident about the prospects of property price, and they're trying to offload that. And that's a new phenomenon in the Chinese market. And so even as housing sales start to pick up, which they are doing overall, what we're seeing is that that home demand is getting diverted into the second-hand housing market, and it isn't helping developers straight away. So it's, they're buying up some of these second-hand houses, but they're not bringing down the inventories on the new market. And that's why it's going to take several years still to pull round.
Duncan, you mentioned a moment ago about the deep investment in manufacturing that's been taking place and how that could still suppress prices that we see coming out of the sector. Today, we're setting up for potentially a very big announcement from the Europeans around trade tariffs on EVs, electric vehicles coming out of China. As you look at the dynamic and those investments taking place, is it right in your view that the Europeans come up with countermeasures because of the subsidies that China's bringing to the table, making it uncompetitive for European players?
Well, this is obviously an area of huge debate, is it right or wrong? I think the reality is, and I can understand this, in Europe, tens of thousands of jobs are in the auto manufacturing sector. France, in Germany, many key countries. And so from a political, social standpoint, you can understand that political leaders are putting in place, or may put in place, barriers to protect those jobs. I think failure to do so, failure to protect the manufacturing heartlands, at least is one of the factors that perhaps has contributed to what we saw over the weekend, over the last few days, this rise of far-right parties across Europe. So I think there is a social political rationale for protecting key manufacturing jobs. But the reality is that this is one key sector where China has become extremely competitive by targeting it, including with government policies over the last decades. And there are other sectors where China has emerged and will become competitive. We're already seeing China the piloting of the next wave of self-driving cars, for example. So we could well see for other sectors where China takes the lead in terms of manufacturing technology and builds up scale.
Yeah, Duncan, look, this conversation is one that I think we'll continue to watch because it's never ending, really, and there's so many different aspects. Thank you so much, though, for breaking it down for us as well here on the show. Duncan Wrigley is Chief China Economist at Pantheon Macroeconomics. Now, the US is reportedly mulling another tranche of restrictions on China's ability to access chip technology that's used in artificial intelligence. That's according to Bloomberg, which cites people familiar with the matter who say the tech in question is a new chip architecture called Gate-All-Around, or GAA. That tech is set to enter the production chains of the world's biggest chip firms within the next 12 months. Now, Nvidia and AMD both posted modest declines in Tuesday's trade.
The European Union is expected to reveal its tariff rate plan for Chinese electric vehicles as soon as today, as the bloc cracks down on low-price subsidized imports. That's according to the Financial Times, which says the rate will be hiked to 25% from the EU standard 10% duty on imported EVs. Fascinating how political this has just gotten after the weekend events. Apparently Germany has launched an effort to try and avert a full-scale trade war. Politico has been reporting on that. You've had losses that have been suffered from the German side, from Olaf Scholz, across to France, as we were reporting on yesterday with Emmanuel Macron. And of course, Ursula von der Leyen is still seeking support too for her position. So everybody seems to have some sort of separate side issue at stake as we talk about these tariffs. But the reality is, and I think it was just interesting to hear Duncan talking about the implications for the far right in various countries, that there is a feeling in a lot of economies that they're being left out. And whether we put some props or protection fencing around future industries, is it going to get worse?
It's interesting that on the back of this report as well, then Aneta, our own reporter, of course, out of Germany, actually made note of how significant this would be and why there's such a divergence, particularly out of France and even out of Germany. Germany, of course, having more luxury vehicles, which kind of need China a little bit more. And that's why they'll ultimately try to avoid a full-scale trade war in this regard. Whereas perhaps France, with the lower sort of scale vehicles, so to speak, may be finding it that, well, these tariffs will be necessary in order for them to maintain their ability to compete. So there's so many diverging views, and as you said, there's definitely politics in all of this.
No doubt that Chinese are going to have some very strong language here, and I wonder whether they could be relieved if it's a 25% level and not 100 like you've seen in the United States. So the market is still open to them. We'll have plenty more on this with Pirelli's Executive Vice Chairman Marco Tronchetti-Provera, who will be on street signs at 10:15 CET.
Now, coming up on the show, Apple shares posting their best day since 2022. As investors digest the company's juicy AI announcements, we'll have more on this after the break. Plus, eyes on the Fed. More specifically, its dot plot. Traders split over whether the central bank will cut rates in September or even perhaps a little bit later. We'll discuss this hour. And later today, we'll be joined in by the CEO of Bilfinger as the company holds its Capital Markets Day. Don't miss that interview. It's here live at 8:15 CET.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Apple shares have hit a record high, now above $207 a piece, witnessing their best day since 2022 after fresh announcements from the company's WWDC event. It announced AI features across newer devices, including an updated Siri voice assistant, integrated ChatGPT, writing assistance tools, and image generation. That left Apple on the cusp of overtaking Microsoft to regain its position as the largest US company for the first time since January, and widening the gap between itself and chipmaker Nvidia. The initial market reaction to Apple's AI announcements was lukewarm, but yesterday saw at least 13 analysts raise their price targets on the company. That comes amid expectations that AI features, which are only available on the very newest iPhones, could accelerate device replacement cycles. Altimeter Capital CEO Brad Gerstner told CNBC he had bought Apple stock ahead of the WWDC event, expecting it to become one of the key players in the AI race.
Apple, with 1 billion users, is going to play a significant role in introducing AI to the masses. And part of the reason, that we like Apple is only 5% of Apple users today can access Apple Intelligence. So they're going to have to upgrade these devices in order to play. But let's be very clear. Google's still in the game. OpenAI directly through ChatGPT is still in the game. Meta very much in the game. And then there are other players. But in the consumer game, don't count out Elon, right? X.AI is going to have a ton of capital. They've got an incredible team, and they're going to come at the consumer space.
So Apple having a very strong day. And don't forget, if you look at the performance of other AI names, it is a little bit hard to argue that there's a huge amount of AI hype around Apple. I think the market's been very cautious, concerned that it could be disruptive, that it's been left out of the race. I think the event that we saw this week proved that it's got some irons in the fire. So that is positive for the company. But from a techie side, the fact that it can't build its own AI, the fact it can't build its own large language models suggests a real lack of innovation over at Apple. So I think there is a right to be cautious still at this point in terms of what AI does for the cycle. We've been talking about it accelerating the cloud cycle. That's only been for some players at this point. It's not been across the board. So can we argue the same point around the consumer devices from phones to PCs? Is it also going to be as easy as that? You put a bit of AI on the device and the consumers come knocking, or is it going to be a little bit harder for Apple to try and execute?
I mean, what if, and I genuinely ask this because you've had this upgrade cycle that perhaps has lagged behind. 270 odd, if not 300 million devices of 1.5 billion that still need to be upgraded or haven't been upgraded then by consumers. So you still have that pent-up demand. It's there. Is this enough to get all those people saying, well, yes, I now need to know what all of this is? Why would you, is that for Gen emojis? Is that going to be for the fact that I could possibly change the color of the apps that I have on my phone? Because
summarizing documents, maybe?
I mean, maybe, but how many people really go down that? And I'm not saying that they won't. I'm just saying how many of them will do that? The novelty of all of these aspects, does that keep the long run growth of Apple's devices in check and in play? On the other side, and if I just want to add as well, then you have the tablet that you've just put forward not so long ago. You can get exactly this AI tooling on the MacBook, on your cell phone device. Why would you then get a tablet? So now how's that ecosystem gotten any better?
Is Apple disrupting itself? Yeah. I think there's a broader point here too. as you say, when it comes to whether the consumer is going to be motivated into this cycle, it may just sustain the prices that we've seen, that the consumer doesn't get fatigue, and that it says, yes, I'm willing eventually to still pay that sort of money for a high-end iPhone when I wouldn't have in the past because I'm getting a little bit over the cycle. It's another reason to buy. So it doesn't get disruptive, and that may just be the good news and maybe as good as it gets. In terms of the fact that you've now got Apple riding on the coattails of others from OpenAI, and eventually it may be Google as well, if it comes up with a device or AI around Gemini that is good enough for Apple to put in its devices. Well, then maybe too we get some more news flow there. But effectively, is it shrinking its own moat? Because if you can simply plug in with some sort of platform that is created that is has no real star power, if you can just plug into the AI, does that mean Apple is actually shrinking its moat and some other company can do exactly the same thing?
Because what would stop? If OpenAI is meant to be this free platform, what's stopping OpenAI from doing the exact same thing with other businesses?
Absolutely.
Right? So it really could
That's
go...
the problem with collaborations and partnerships.
100%, especially if you don't own the network yourself, which Apple has done for so many years. So yeah, many problems, I think, or many things that we will look at in all of this and whether this ultimately works out. Here's another one that certainly will be very interesting. Elon Musk dropping his lawsuit against OpenAI and Sam Altman, accusing the firm of straying from its original mission. That's what he had accused the company of in order to benefit humanity. A hearing was scheduled then for Wednesday to consider whether the case should be dismissed as requested by the defendants. Musk's decision to file to dismiss the suit did come just one day after he publicly criticized the very same OpenAI as well as its partnership then with Apple. At the same time, Mistral AI has raised 600 million euros in fresh funding, valuing the company at nearly 6 billion euros. Now, the investment round was led by General Catalyst as well as a number of Mistral's existing investors, which do actually include Microsoft, and was backed then by the likes of Nvidia, Salesforce and IBM. Now, the Paris-based startup, which was only founded last year, makes large general-purpose AI models, has been touted as a key challenger to OpenAI.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.